All right, listen, I'm going to teach you how to value a commercial real estate property even when there's no tenant in place. So first, we have to understand that there's a difference between residential and commercial property and how they're valued. So in residential, if you have maybe a cul-de-sac of properties all going for $200,000 a piece, that fifth and sixth property in that cul-de-sac is going to go for $200,000. It doesn't matter if it has, granite countertops or, a brand new bathroom, because residential real estate is valued based upon the comparable sales. Commercial real estate, on the other hand, is valued based upon the rental income. So what I mean is if you can increase the rental income, you increase the value. But the problem is, though, with commercial property, sometimes you can buy or potentially look at a vacant warehouse. So how can you value a vacant property if there's no income? Let me walk you step by step from start to finish on how to do this. So I made this little calculator here. It's nothing crazy, but I kind of came up with this little rule. I like to call it the 70% rule. And this is how I come up with it and the reason why. So let's say, for example, that there's a building for 13,000 square feet. These are the exact same steps that I go through when I'm buying my own buildings. Let's say there's a building going for 13,000. There's a 13,000 square foot warehouse. The market cap rate is 9%. The rent per foot is 6%, and the projected rehab is $110,000. All those numbers are variables, but let me start from the beginning. I like to buy properties in this 10 to 40,000 square foot warehouse kind of space because it's a little bit too big for the solo guy to take down, but it's a little bit too small for maybe the hedge fund or the REIT to try and take down too. So I found a little sweet spot that I like. The way that you discover this rent per foot metric is speaking with a leasing agent that actually has a beat on the market, and maybe he's rented some space around that area, and he says, yeah, Nolan, after you rehab the property and you get it rent ready, I know that I'll be able to lease this property for maybe $6.50 or $7 a foot, but you should probably run your numbers conservatively at $6. So that's how I come up with that number, is by having a guy on my team that can tell me that $6, you can be very confident with that price. And so the market cap rate, of course, is something that we really can't change. It's just what people are willing to trade properties for. Again, if they didn't have any debt on the property, it's just what you would get in return, your cash on cash. And then, of course, when you're doing your due diligence, the projected rehab is just going to be your contractor going through the property and giving you a baseline of what needs to be done in order to get that property functioning and ready for a new tenant. So the intrinsic value essentially is basically the easiest way to determine the actual value of the property. So if you notice what it is, essentially, it's the building rent, or it's the building square footage multiplied by the rent per foot, and then you divide that by the market cap rate. So very easily and plainly, it's the gross net operating income. And because triple net real estate, basically, I'm not paying any of the expenses, so my gross income is also my net income. So basically, it's our net operating income, and you divide it by the market cap rate. So basically, I can change this from 9% to 8%, and it's going to change the value, right? But if we're using a 9% cap rate, which is pretty standard right now, this value of this building, when leased up, is going to be $866,000. So what I like to do, and I'll explain this in a minute, is let's multiply this by 0.7 to get $606,000. And I'll explain why the 70% is so important in just a sec. But we're trying to get down to our highest and best offer. So after we subtract our projected rehab cost, and then we subtract also our leasing commission, which leasing commissions are really easy to discover. The way that they do it, at least where I am, is you take a gross lease. So let's say that our tenant is paying $78,000 a year. The rents go up 3% every year for 5 years. You essentially multiply that gross amount of rent by 0.04. Maybe you can negotiate it a little higher, a little lower, but that's been pretty standard for me as 4%. And then that equates basically out to your leasing commission. And then I subtract those two numbers, and I get down to this highest and best offer of basically $480,000. To go back to the reason why I like the 70% idea is because I know that once I have the building leased up and I know that I can season the lease for 12 to 18 months, I know I can have another banker come over the top and want to refinance this property. And because I know that the value of the building will be $866,000, again, maybe a little deviation depending upon the appraisal, but this is pretty much par what it'll value at. I know that a bank will give me a loan of 70% of the appraised value. So what they'll do is they'll pay off the first loan, they'll pay off all the equity that I would have injected into the deal, and then I'll have a brand new loan of, this $600,000, and I'll be in this deal for absolutely no money. So what I'll be able to do essentially is just recycle the same capital and just keep doing more deals, because again, these properties that we're buying are vacant out of the gate, and we're increasing the value by increasing the income. And another piece why this is so important is that most people would look at a vacant warehouse and say that thing is worthless. It's, it needs to be taken down or whatever it is. The biggest part of this is that the owner of that property doesn't know its intrinsic value. Maybe they received this property in like a trust, or someone they inherited it. They don't know what its value is. So maybe a highest and best offer out of the gate of $400,000 would be way better than what they ever could have thought they would get for a building that's just been sitting there dilapidated and just basically costing them money because they're paying insurance and taxes on it. So one man's trash is another man's treasure. But this is exactly how I make offers on my buildings every day of the week. It's very, very easy. This is the easiest, math that you can do. And so if you have interest to learn more about how you can, learn how to buy properties and make these offers and negotiate financing, we have what is called the CRE Collective. And what this is essentially is just our private mentorship and our mastermind. You can see we've got basically a private kind of Facebook group on steroids where we have all of our forums where everyone's asking questions, talking about financing and doing deals and goals that we're trying to do. Once you join our group, you can go into our classroom and you start right here and you get all the, you have access to all of our pro formas and all of our information and all the spreadsheets that you'll need to be successful. And then as you go along, you can learn and not to mention watch all of our previous recorded videos. So what we're trying to do is expand the knowledge of people that are out there wanting to switch from residential into commercial, because the numbers are bigger, the money's more passive, the debt is easier to achieve, and you're going to be getting to financial freedom so much faster if you go through commercial property versus residential. So if you want to learn more about how you can join our collective, how you can actually go and figure out ways to, make offers on buildings like this, very simply, click the link in my bio to schedule a call, and I'll show you how to get started.